You're probably interested in maximizing your share of the many billions of dollars available to American businesses through the R&D tax credit.
We're happy to be here helping to give people some information about the R&D tax credit and some of the upcoming changes and what they can do to prepare. It's a very timely topic. Today we want to cover the R&D tax credit generally and give you a little bit of an orientation if you're unfamiliar about what it is, how you can qualify, and what it could mean to your business. And then we want to cover ever evolving, but newly upcoming, we'll say, for 2025 disclosure requirements and some additional things that are going to be needed in order to make a valid claim for the R&D credit, and how accurate time tracking that works well for your employees can really feed into claiming that credit and helping to maximize it. We see companies all the time that because of poor data or just lack of understanding or knowledge about the credit miss very large opportunities. We had a client that came to us that was in their fourth or fifth year of operation, had been investing heavily in R&D because it was a medical device company and those expenses can grow rather quickly. They just missed the credit. And unfortunately, we had to inform them that they left several $100,000 of credit that could have been used to offset payroll tax on the table, and there was no way to go back and get it. So organizing it from the start and as early as possible and getting good advice is really what's important in this process, and making sure that you go after the R&D credit. The credit can mean 5 to 10% back of eligible expenses to your company at the federal level. It can reduce your tax liability to zero in most scenarios with a few small limitations. It can be carried forward for up to 20 years at the federal level. California credit, similar in scale and benefit to the federal credit. You wrap both those together and you can be talking on the high end about 20% back of what you're spending on qualified research expenses back as a general business credit to your company. This can also be very valuable for startup companies. The R&D credit can be used to offset payroll tax. Whether or not you're making money, whether or not you have taxable income, if you have employees, you can generate up to $500,000 of credit that will be eligible to offset payroll tax if you're in your first 5 years of gross receipts and the year in question is below $5 million of gross receipts. That $5 million test is a year-by-year basis. If you're still in that first 5-year startup window, you just judge each year as you go. And if you're over 5 years, the credit you generate would just be a general business credit. If you're under that $5 million threshold, you could continue to elect up to $500,000 in credit to offset payroll tax. What is eligible? Generally, new and improved products or processes. They don't have to be revolutionary to the world. They can just be evolutionary to your business. Just because someone else has theoretically maybe done it before does not mean that it's off the table for the R&D credit. Throughout this, I'm also over the next several minutes going to mention the word business component, IRS shorthand for project. Those are relatively interchangeable and mean essentially the same thing. One is IRS terminology, the other is what you and I might call it in our everyday business, a project. The four-part test, these are relatively broad guidelines that any project or business component must be evaluated against in order to qualify for the credit. The project needs to be technological. The big item here that the IRS spends a lot of time evaluating is this process of experimentation, demonstrating to the IRS how we went from initial theoretical idea to prototype to testing to final product. That's an important thing to demonstrate to the IRS. And that what you're doing is intended to make your product or process faster, cheaper, better, function, reliability, quality of the product or process. There are some very specific exclusions for eligibility to the R&D credit. And that's for items that are research after commercial production, general business software, things that are done outside the US. For the R&D tax credit, the research, the expenses need to be in the US. Things that are done for social sciences, surveys, those sorts of things that are ancillary and a lot of times very important to R&D, but are not considered the true technical portion of the R&D. Also important to consider the visual part that people see on the screen, that UX development. For the most part, the IRS wants to consider not a qualified portion of your business component. The way we generate the credit is by attaching expenses. The categories of expenses that can help generate the credit are the wages of the people involved. So direct conduct, direct support, direct supervision. This is a category that makes sense to a lot of people, though the footprint can be bigger than people think. It's not just the engineers doing the engineering activity. It's potentially the people supporting that activity, the people supervising that activity if they're involved at a very technical level. Supplies and computer rental are very similar categories, so things that are used up in the R&D process. Those might be physical supplies, things that are used for pilot runs, R&D subscription. Computer rental is cloud computing, think AWS, think development environments, things that can be attributable to those qualified business components. And then the final category is contract research. Any effort that is needed for your R&D project by people that are outside of your company. You engage somebody for testing and certification, some software development resources maybe you don't have in-house, patent attorneys. Those sorts of things can be considered a qualified expense in R&D credit project. That was a whirlwind overview of the R&D credit, and the landscape for the R&D credit is continually changing. But now we know the IRS is going to start requiring additional disclosures starting in 2025 on the tax form itself. And what they're wanting to see is some additional detail that they consider that companies should already have in place. Are you electing the payroll tax offset Section E as required for 2024? If anybody's looking at the R&D tax credit in the current tax year you're probably working on, there's some additional info. They want to know how many business components, are there any officers' wages, right? So some information that has not previously been required is even starting here in 2024. And then moving on to the next section. Again, more information, but it starts to get into some more detailed disclosure. There's not going to be that many companies that fall within those guidelines that would allow them to not make this additional disclosure. So here's a preview. What the IRS is going to want is a listing of the business components. Tell us what this applies. Tell us what the computer expense, the lease expense was for each project. In this way, we're seeing that this additional level of detail or accuracy that the IRS expects. It's a lot. There's a lot of additional information that if it's not organized well, it becomes a big obstacle for companies to actually claim this credit on the tax return to begin with. So if you're looking at that form thinking, how do I get all the business components on there? How do I allocate all the hours by business component, by employee, etc.? A good way to do that is some sort of time tracking. So if you have time tracking, what do you need to do to prepare? Just not much, basically. If you have great time tracking, that's wonderful. But if you don't have time tracking, now is a great time to start. Or if you have poor compliance, that's another thing that we see from time to time. We'll have a client that says, oh, we have time tracking. And then we look at it and it's not the right type of detail. It's not the right level of detail. It's a situation where bad data sometimes is worth not a whole lot when it comes to doing the analysis. So making sure that you implement some sort of time tracking, get good compliance, and have people using the system. Remind people to charge their time and make sure that you're capturing as much of that time as possible in the system. As we discussed earlier, you don't want to leave credits on the table, and the IRS really expects companies to have time tracking. Their gold standard is project level time tracking, where you can track people's effort back to the individual business component. As a cautionary tale of a little Sandy Cole case, somewhat recent tax court case, the tax court rejected their entire credit claim. I think it was over $1 million in credit because they had inadequate time tracking and couldn't prove to the level that the tax court expected. If they had just had the information available, the tax court didn't actually disagree that they might have had plenty of qualified business components. They just didn't think there was enough detail in order to allow them the credit. We have clients ask, what do we look for in a time tracking solution? Especially our tech clients, our manufacturing clients, they invest heavily in R&D. They're very protective of the time of people that are doing the R&D. They're doing the qualified research on developing these business components. So overall, what we see is it needs to be easy, and it can't be confusing or call it expensive to the employee in terms of time, because if it's expensive for the employee, then the compliance starts to lag. The data becomes not nearly as valuable as it could. What we're also looking for is an audit trail. We need to be able to see the data, get the data out that's needed, good categorization, good reporting. There's two parts. We want good data in, but we want to be able to get good data out as well.
So we've seen that wages are obviously a huge component of the R&D tax credit, and we've seen how careful time documentation is needed to support the highest level of claims. But, and no offense to Cole, finance and accounting pros are not always in a position to drive organizational change and ask users to adopt a new behavior. Often the management systems that are in place are not already set up to track the R&D time in a compliant manner. So you've got the risk of creating redundant pathways to time tracking, which is not the answer. In fact, by combining R&D time and non-research time in a single fabric of data, both the pursuit of tax credits and other general management objectives can be pursued at the same time in a single system. We worked with the research division of a global pharma company. They had been struggling with an older proprietary system tracking efforts on clinical trials for new compounds. And they were struggling with inadequate reporting, and the preparation of tax credit claims was becoming increasingly difficult for them. They knew they could be claiming more in the way of tax credits, but they simply could not see how much time researchers were spending on the eligible work easily enough from the ineligible work. Time entries were not contemporaneous. The accuracy of what they were gathering was dubious. They had administrative overhead involved in some internal processes to do internal chargebacks. We implemented a time tracking platform to achieve all of these goals. First, by pushing complexity away from the users. User convenience means user participation, and more participation means contemporaneous time input. Secondly, on the back end, we manage the enforcement of which credits are R&D eligible and which are not. Finally, on the back end, we gave them purpose-built reporting to extract both tax credit documentation that they required and other critical reports for their non-R&D functions and for the rest of the business. We attach the required attributes to their projects, or the business components as the IRS calls it, each of which lets managers extract different streams of reporting depending on the business priority. And it all derives back from a properly structured project taxonomy. So in the end, this company was able to achieve their goal, a single source of truth, what we'll call great time data properly organized. They had data good enough to claim greater benefits, greater tax credits than they had originally planned. And in the process, they gained two other operational advances: forward-looking staffing forecasts, and second, they did achieve a massive reduction in the administrative workload to produce the necessary reporting and to prepare the documentation for chargebacks to their parent organization, which in turn supports higher and better R&D budgets for their division going into the future. So to recap, when an organization's time tracking system is properly established, tax credits become just one of the ways that investment pays off. The benefits extend far beyond just the compliance need, and they really help companies reach their strategic objectives in every area that pertains to labor and the cost of that labor.
More and more, we're seeing companies decide to track time because of the R&D tax credit, because of the disclosure items we've been discussing. But I think they're going to find a lot of additional value in that data and maybe realize that they wish they had done some of the tracking that they're starting to think about doing a little bit earlier. It's never too late to start. I joke because in the tax world, we're still living in 2024. But the data that is going to be needed for the R&D tax credit for the 2025 filings, all these additional disclosure, that's the real world we're living in now. When we get into the second quarter, it's never too late to start generating good data. And then you'll have that data to meet the needs at the end of 2025, whether that's R&D credit and building on that throughout your business for further insights, budgeting, long-term planning, those sorts of things. Thanks, everybody. Appreciate it.